let me move to the other big development, and you've talked about it. I was seeing in one of your interview, you said this will change the mutual fund industry forever. It'll never be the same. Is the whole debt fund taxation
Hmm.
thing, which came, what should one say? All adjectives have been used already. But the fact, do you feel? Let's move forward. Now, this is a reality. We can criticize it, but the fact is now this is the law of the land. And I know
Of
that
course.
people like you and others may be trying very hard in the next, whatever, we are recording this interview on the 29th. So there's 2 more days. And I'm sure you're trying your best to lock in people. But post that, let's try and understand. There is no doubt that debt is a very, very important part of asset allocation, something you've been saying for many, many years. Do you therefore see? So I don't think any financial planner will say that, look, I don't want you to be in debt just because it
Yeah.
has taxation. But pure debt schemes, and we don't need to argue about how good they were. I mean, the
Yeah.
target maturity funds, the ETFs, they were all serving a good purpose and were about to take off. But well, let's leave why it happened to a separate conversation. But do you foresee categories like hybrid, like balanced advantage fund, about which we've talked in our previous interviews, equity saving schemes, schemes of this kind becoming more popular? They're already fairly popular
Yeah.
because from an advisor or a distributor's point of view, you would obviously want an investor to have a good asset mix. And rather than creating portfolios of debt schemes, you might just go for a more of a, balanced advantage fund or a, I don't know. There are many categories, and if you can talk about that.
So yes, I think that clearly for fixed income funds, before this latest change, the fact that anything held for 3 years was, classified as long-term capital gains, and that entailed 20% tax less indexation, which would, in a certain environment, tantamount to pretty much very low tax or no tax. So now that is clearly gone, right? And everything would be classified as short-term gains. There is no such thing as long-term gains for debt mutual funds. So that has, really taken away one big advantage, because in the past, interest income was getting classified as capital gain, and hence, uh, so I think there were some advantages. Now, clearly, having gone, what it does is that the people who want to invest purely into debt, before I come to your point about how will people manage the mutual funds and the allocation. Let us say somebody was going to invest purely in debt, and putting money in equity of any sort is, let's say, not an option. So people who are going to go only into debt, now they will not just straight away go into a mutual fund. They'll compare that, which instrument has the highest headline return and entails the least expense. And, that's what they'll go for, because tax treatment would be same everywhere. In fact, a lot of people like corporate treasuries and family offices or certain HNIs, they might even just directly hold some bonds which are listed, and they might still be able to enjoy capital gains on those bonds. So people who are pure fixed income will go for the highest possible headline rate of return, because mutual funds don't have any tax advantage now. Coming to retail investors, look at it this way, that previously when people were buying debt funds, like you mentioned, target maturity or any of those, holding for more than 3 years was classified as long-term capital, long-term gain, which means that to get a concessional rate of tax, you had to anyway hold for minimum 3 years. Now, if you're not a corporate, or if you're not somebody whose constitution precludes you from putting money in equity, and let's say you're allowed to put in equity, or you don't mind putting money in equity, so you will think that, okay, anyway, I was going to hold for more than 3 years. What's the harm if the fund has, 15, 20, 30% into equity? Because yes, 3 years, 100% equity, you're definitely taking some risk. But if you're going to hold more than 3 years and the fund has, let's say, 35% in equity and 10, 15% worth of arbitrage, which reduces the effective equity position to say 20% or something, then I think it will still have long-term capital gains after 3 years. It will still be 20% less indexation. And some of your equity allocation, you can carry it through this hybrid kind of fund. Same logic, I think, applies, when you mentioned balanced advantage funds. Now, ideally, people put money in equity, they put money in debt. But if you put money in a balanced advantage fund or a aggressive hybrid fund, which ends up putting 30, 40, 50% of your money into fixed income, but is still taxed as equity, then you will say that, okay, it's better to create debt and equity as hybrid exposure, and the whole, whatever small part or whatever part of debt you have, that also enjoys the lower rate of taxation. So clearly, I think, I mean, I'm not in the camp that taxation should determine your asset allocation. But the point is that if your ultimate asset allocation is going to be what it is, and it can be more efficiently met through hybrid funds, then I think people will definitely be open to choosing that.
It's also about simplicity, isn't it, Ashish? I mean, you know, fixed deposit is something a lot more people in India understand than even a mutual fund. Forget about debt or equity. And if the difference is very marginal, I mean, I know as a mutual fund company head, you have to, probably, I'm not talking about you individually, but as the industry. But the fact is that if it is a very small difference, I'd rather go to a product that I understand, which is a fixed deposit.
Absolutely. Yeah, yeah, no doubt about
And,
it.
and probably, and I know in your previous avatar, in your previous role, you never had debt funds. You were a pure play equity mutual fund CEO. And I know that, today the industry was trying to bring in retail investors to benefit. And
Yeah,
maybe now the real fun would be in educating people and making them understand balanced funds and equity more as an asset class. Perhaps, let's see how it evolves. But thank you very much, Ashish, like always, for taking time out and speaking to me. I look forward to many more conversations with you here on Money Paathshaala. Thank you very much.
thank you. Thank you for inviting me. Thank you very much.